Good morning, everyone. And that's the first and hopefully only technical hitch for the whole morning. I was on mute, so unless you're an incredibly good lip reader, you'd have no idea what I was talking about. But it does give me a chance to say thank you once again for joining us. This is the biggest ever Reed attended event with over 800 people, actually just shy of 900 people booked in to attend. So thank you all very much for that. My name is Mike Jones. I'm the Senior Regional Director for Reed in the Northern Home Counties. I've been here 15 years. We're going to hear from 4 excellent speakers from PwC today. So join us. We have Seamus Devaney, Tax Partner, Nick Forrest, the UK Economics Consulting Team Lead, Samuel Carter, the Director of Private Business Tax, and Matthew Clark, Director of Head of UK and Customs. So we're going to tackle the budget from all aspects. Before we go into that, I thought it would be useful to provide you with some job information because Reed are very well positioned to do that. So fundamentally, you'll hear a lot of stories in the news about unemployment, etc. But I'm really pleased to say that jobs are on the up. So jobs posted on reed.co.uk last week were up by 25% on the prior week, which is a huge rise, absolutely huge rise. And that was also backed up by statistics from the ONS, with 56% of firms looking to hire this year. So there is, underneath some of the struggles that we've had, there's some real positivity in the market. I do want to temper that a little bit because we are seeing from lots of our clients that the expectation of the talent in the available candidate pool is much greater than what it is. So what we're actually seeing from candidates is some hesitancy and reluctancy in moving because they want to stay in a secure job. And obviously, a lot of companies are trying to secure and retain their best talent. So if you are looking to recruit, my biggest advice to you is put your best foot forward in terms of the package you're offering and move with speed, and throughout the process, show that candidate why you are the best company to work for. But finally, I'll just say, Reed are here. We are stronger than we've ever been. So if you are looking for work, or you are looking to employ someone, or you simply want some advice on how to do that, then please get in touch with us. That's enough from me. So I'm going to move on now to PwC, and we're going to start actually with Seamus, who's going to give us a bit of an overview of the budget just to set the scene. So Seamus, over to you.
Thanks, and morning everyone. Good to see so many of you here. Obviously a very important event in the economic calendar dealing with the annual budget here in the UK. Just a bit of context, and then we'll get into the sort of specifics of some of the things that were announced by the Chancellor. Normally when we do these types of events and updates, there's a real focus on, you know, some of the intricacies and the mechanics of the tax changes in the various areas. But I think this year more than ever, it's good to understand the wider picture, because this budget, yes, there were some changes to the way in which the government will collect money, but actually much more of this is around how it's spending money. And typically when they do these budget briefings, we don't focus on that to the same extent. Clear message from the Chancellor is, as we move into recovery phase, there's a will to make that as job-rich recovery and create as many jobs and protect as many jobs as possible. And that was the underlying mantra of a number of the announcements we saw on the spend side earlier in the week. So, you know, for example, the extension to the Jobs Recovery Scheme all the way through to September to ensure that that continues to keep people on payroll until the economy begins to bounce back in a more substantial manner. There's also the self-employed support scheme. There are restart grants in the hospitality sector. There are VAT deferrals. There are various things which are designed purely to ensure job creation and job protection remains the #1 priority. It's also useful to understand the numbers here as well. I was looking back at some notes I was doing 2017 budget update, and part of that was a clear glide path to balance the budget within a 5-year plan. And around that time, the budget deficit was sort of in the region of 45 billion. Where we are going to get to at the end of that 5-year period from 2017 is a budget deficit of 350 billion. So you can see how things have very substantially changed. I think the positive we can take from what we heard on earlier in the week is the drive to balance the budget has completely been stalled. The real focus is on spending money in a directed manner to ensure the recovery is as fast and as jobs rich as possible. So that's really the context around the conversation we're going to have today. We'll cover some of the specifics on the tax areas. We'll get into a conversation around some of those support schemes as well. So, and also obviously, as we go through this, if you want to raise questions, etc., those will get to us, and we'll try to deal with the general trends that are coming through on those. Okay, thanks.
Thank you, Seamus. Yeah, and Seamus just alluded to it there. There is a Q&A section throughout the whole of this webinar, and once we've heard from all four speakers, we will come back to that Q&A. So any questions throughout, please put them on there. I'm going to start by coming to Sam Carter to talk some more about the tax, so private business tax, etc., corporation tax. So Sam, just to start off with, given the amount of speculation around possible tax hikes in the run up to the announcement, this week's budget was actually fairly quiet on the tax front. So can you just quickly recap the key points that did come out from a business tax perspective?
Yeah, brilliant. Thanks, Mike. So yeah, exactly as you say, and picking up Seamus's comments a second ago, although the Chancellor talked in a reasonable amount of detail around his plan to repair public finances and the importance of getting the economy and public finances back on an even keel, that's very clearly the second phase of the plan at the moment, and the focus for the budget was very much on spending measures rather than revenue generative measures. And was particularly around, as Seamus says, the securing the recovery and ensuring that we're continuing to create jobs in the short and medium term. So what that means is that a lot of the potential tax rises that I think we're all expecting to come through at some point have been pushed out further than we might have anticipated if we were speaking back in October, November time last year. So in particular, I suppose, what we've seen in the press for quite a while now is a lot of speculation around personal taxes, wealth taxes, capital gains tax in particular, harmonising the position between the employed and self-employed. All of that's not necessarily come off the agenda, but has certainly been parked for now. So what that leaves us is relatively few announcements in the budget itself. The key headline, obviously, which everyone will already have seen, is the increase in the headline rate of corporation tax. Obviously, it was fairly well trailed that the government was looking at corporation tax and was looking at potential increases. I think we'd anticipated, probably it's fair to say, a slower and slightly lower increase. So I don't think anyone's expecting us to go quite as far as 25%, and I don't think we were expecting that to come in full from 2023, which is what we've got. So we've got a 6% increase in the headline rate of corporation tax coming in 2 years' time. Now, I suppose that's the government usually gives on the one hand and takes away with the other, but I suppose in this case we've got the opposite. So that's the potentially bad news, I suppose, from a corporate tax perspective, or at least the factor that people need to build into their budgeting and cash flows. I suppose the upside is that continuing that message of building back strong and securing the recovery at the moment, what we've seen is a couple of reasonably significant announcements around tax reliefs and tax giveaways. So the two big ones here are the so-called super deduction for capital investment. So there's a 130% first year allowance for qualifying capital expenditure in the next 2 years. And obviously you'll see that the timing has been obviously considered quite carefully. So the super deduction runs from now until 2023 and ceases when the increased rate of corporation tax comes in. So there's definitely an incentive there to bring forward capital expenditure where businesses can. Now on that's actually relatively broadly drawn, but it's worth knowing that there are some specific categories of expense that aren't included there. So particularly around leased assets. So leasing businesses, landlords probably just need to be a bit cautious about what's covered there. It's worth saying also that although the headline 130% super deduction is the main point there is also a similarly extended special rate relief. So for qualifying special rate assets, long life assets, for example, there's a 50% first year deduction available. So we've got that. The other main thing that's been given to us is extended loss carryback. So we've seen a return to extended loss carryback rules, allowing businesses that were obviously previously profitable but have now been hit by the pandemic to claim a bit of a liquidity boost. So we've got an ability to carry back up to £2 million into each of the previous 3 years. Obviously, what that means is that we've got quite a lot of thinking for tax teams to do, to be honest, and understanding of how decisions on expenditure in particular over the next few years and medium-term capital investment programs are going to be affected by the reliefs and the increased tax rates. And it's also worth saying the last thing, which wasn't flagged in the budget particularly, but was included in the budget documents. There was a consultation released on Wednesday around the research and development tax credit regime. Now, the shape of the consultation, that's obviously a call for evidence and is something that affected businesses will no doubt be looking at quite carefully. But the shape of that probably looks quite positive, I would say. And certainly it's quite possible there will be on the back of that, there's scope for the R&D regime to be broadened in its application. And I think obviously that will also factor into investment decisions where businesses are potentially. I think from my perspective, those are probably the key points on tax from a business perspective.
Thank you very much, Sam. And I think you've kind of gone into the second question a bit, but I'll still go just in case there's anything that you'd like to add. So there's clearly going to be a very complex interaction between short-term reliefs and the long-term rate rises that the Chancellor announced, where businesses are looking to plan spending and tax strategies. Are there any key areas, though, that the businesses should be looking at if they want to ensure they're maximising the value of the reliefs the government has announced?
Yeah, it's an interesting one because obviously if we look at sort of patterns of behaviour, generally speaking, if we've got a planned increase in the headline rate of tax, then the usual behaviour is to defer expenditure over the next couple of years until you can take a deduction at that higher rate of tax. So what we'd usually expect is to see a delay in significant capital spend and in significant items of expense going through businesses. And obviously, if we think about the context of the budget as a whole, that was obviously a key driver in the announcement of the super deduction, was to forestall that behaviour, and that's why we've seen that incentive in the other direction. What that means, though, is that for different businesses, when you look at the increase in the rate of tax that's coming down the line, you look at short-term incentives to accelerate qualifying capital expenditure, and you look at the various rules we now have around losses. So you've got an ability to carry back losses for an extended 3-year period. You've also got an ability, obviously, to crystallise losses where businesses are obviously in a loss-making position at the moment and can put themselves there with expenditure items and deductions. You've got a position to crystallise losses now and then obviously carry those forward into the post-2023 regime where you've got potential relief at a higher level. Now, all of this is bound around by existing restrictions. So, all of the existing restrictions on loss carry forward and capping of losses at 50% once you're above the threshold still apply. So all groups are going to find themselves in quite a different position on a lot of this, and it's quite important that not just when you are thinking about significant capital expenditure, when you want to time that, and significant items of expense and income recognition, but actually just understanding from a cash flow and effective tax rate modelling perspective what the cash tax cost through the business will be for the next few years, because it is going to be quite a complex period and quite a hard one to forecast. Now, I suppose to the question specifically, I think there are probably a few things to look at, and this will probably depend on different businesses and how flexible these areas are. But if we think about the super deduction gives us an obvious incentive to bring forward capital expenditure that qualifies. Obviously, there will be significant other expenditure where businesses may have a bit of control over the timing of that. So where you've got revenue expenditure that you have control over, so intragroup royalties might be an example, where you've got pension contributions and you've got flexibility around the funding plan for your pension scheme. Those are areas where you might have a bit of time, a bit of an ability to control the timing of those expenses to take relief at the higher rate rather than the current lower rate. Obviously, for income recognition, the reverse is true. Depending on your business, there's a question mark over whether you've got scope to accelerate the recognition of some income into the current 19% rate. All of that's obviously going to be sort of very fact specific, and it's one of these cases where there's a tax input into a lot of decision making that needs to be made on a strategic investment level. But it is important to understand, because if we think about the scope of some of these reliefs, so the super deduction, for example, can return 25 pence in the pound on capital expenditure. So this is going to be a significant factor in the decision making of the board. I think for me, those are probably the key areas where it's worth looking at timing. The only other thing I'd probably just mention on that is around international tax. So for international groups, there are probably a couple of, I suppose, relatively niche points that come out of this. Firstly, it's worth being aware that the rate of diverted profits tax is increasing in line with the increase in the headline rate. So diverted profits tax goes up to 31% from 2023. The other one that might have a slight knock on, so I suppose there are two other things I'd say. One is that the increased UK rate obviously means that your international tax profile may look different. So businesses with foreign branches may want to revisit whether they're making branch exemption elections and what the difference in effective tax rate is in the UK versus local territories. And I suppose finally, there's an interesting impact here where, because a lot of our anti-avoidance, and particularly around our international anti-avoidance legislation, we look at the effective tax rate, so we look for effective tax mismatches. What that means is we look at whether the other country in question charges at least 80% of the headline UK rate, broadly speaking. So that means actually where you've got any group presence in a territory that has a tax rate of less than 20%, and obviously that's bringing in quite a few countries that weren't previously captured by this when we were looking at 80% of the 19% rate. You've potentially got a fair bit more complexity there. So those are just probably points to be aware of, I would say.
Thanks, Sam. We're having quite a lot of questions come through on the Q&A already, so we will come back to all of those once we've heard from all the speakers. I'm slightly conscious of time, so I'm gonna rush you ever so slightly on this next one, Sam. Apologies, but we're going to move on to personal tax now. So the budget announcement was largely silent on this, despite all of the previous speculation around capital taxes. Are you expecting, though, any further movement over the next year in this regard?
Yeah, so this one we can keep brief, because it's either a one-line answer or the rest of the day speculating. I think we're largely no further forward than we were a short while ago when everyone was speculating around possible changes. So what we do know is the government has announced already that we'll see quite a wide range of tax policy consultations launched on the 23rd of March. So the government's already said that for a lot of the significant tax policy decisions, and I think we can read that as including personal taxes, wealth taxes, capital taxes, trying to make announcements in the budget wouldn't have left time for enough consideration really to be given to the matters. So for the normal transparency, good governance, and allowing interested parties to have sufficient scrutiny of the proposed rules, we're going to see probably quite a lengthy consultation period between now and the autumn, or between the end of this month and the autumn. So I think we're still probably expecting a lot of potential changes around capital gains tax, gradual or partial harmonisation of capital gains tax and income tax rates, a little bit more around the employed versus the self-employed, and probably a look at the inheritance tax and potentially wider wealth tax regimes. Obviously, at the moment, I think directionally we can see that the Chancellor talked extensively around repairing the public finances, but has largely deferred, as Seamus said earlier, largely deferred the pain on that for a while. So I think we can anticipate that there will be movements in those areas, but at the moment we're probably waiting. what that means for individuals, I suppose, and for business owners in particular, is that there's probably a window between now and the autumn statement where we've got certainty in the current position, and probably it's reasonable to expect that rates will be going up in the future. So I think we can see that, and we've already seen that, to be honest, to an extent, driving a bit of buoyancy in the M&A markets, and driving planning and business exit discussions at a shareholder level where you've got privately owned businesses.
Thank you, Sam. And then the final question is now moving on to employment taxes. So was there anything of particular note in the budget on employment taxes?
Yeah, so it was surprisingly light, actually. So again, this is an area where I think we're expecting a lot more to come. Obviously, from an employer's perspective, the key announcements were really around employment support measures. So Seamus has already mentioned that the CJRS, the job retention scheme, has been extended out to the end of September. And that's with employers starting to pick up part of the cost from July. So the scheme continues basically in its current form until the end of September. But for July, employers will be contributing 10% of usual wages, and August and September, employers will be picking up 20% of the tab. So it's not purely at the government's expense. And obviously it's worth saying, that's on top of the expenses that employers continue to bear in terms of employers' national insurance, pension contributions, for example. So sort of a gradual phasing back in of expenditure relating to furloughed employees, but obviously a valuable extension in the meantime. The other one, while on the subject of the job retention scheme, actually, the other point that I think is probably going to be a practical impact, probably the most practical impact, is there was an announcement in the supporting documents that the government's putting a further £100 million towards enforcement activities, specifically around the coronavirus support measures that were introduced. So that's a task force of more than 1,200 people, specifically looking at compliance and governance around access to particularly the CJRS and also the government-backed loans facilities. So I think we've already seen, and I think we'll continue to see, a significant increase in the amount of inquiries and the amount of investigation around CJRS claims. And I think it highlights the need for businesses to have given that quite a lot of thought. Even now, while people may think that the scheme's been up and running for a while and they're comfortable with it, we have seen quite a lot of scrutiny there. Other than that, I would say actually not a huge amount. I think we're expecting the consultations announced on the 23rd. I would be surprised if we don't see something around the employed versus self-employed position. And obviously, people will all have seen the sort of related subjects around employment rights. We'll all have seen the Uber case in the past few weeks as well. So there's probably a bit of movement and quite a lot of businesses to pay attention to around their self-employed populations. But as I say, we're probably waiting to see what that looks like over the course of this year. The only other one that I think I'd just flag is, again, not one that was really picked out in the budget, but employee incentives. So in particular, employee share-based incentives, the EMI scheme, other tax advantage share schemes, they're all being reviewed at the moment. So there was a consultation announced again on Wednesday into the effectiveness and how they can be broadened out. I think on that front, that actually looks more positive than I would have expected if I was speculating on this before the budget. I think the tone of the consultation suggests that the government is quite committed to most of these tax advantage schemes in something like the current form, and we might actually see access to, for example, EMI being broadened out so that it can be made available to more companies. So I think there are some positives to look at from an incentivisation perspective, but definitely, it's a case of keeping our eyes open for the rest of this year on employment taxes.
Thanks, Sam. That's a really good comprehensive overview on those matters. We're going to turn our attention now to VAT. So, Seamus, I'm going to come to you, please. So we heard about a further initiative to allow businesses to defer VAT payments. Could you talk us through that, please?
Yeah, absolutely. And the background to this, we've got a couple of things on VAT, one targeted, one not so. I mean, we know from dealing with businesses in administration or you get into financial difficulty that quite often the regular tax payments that these businesses need to make are the first to create the real financial pressure in terms of cash flow. And so we have a situation where last year a large number of businesses deferred their VAT payments. The total deferral is estimated to be £30 billion. And absent doing anything else, that was all payable at the end of March. So this is a clear drive to avoid a solvency cliff edge for a large number of businesses out there who deferred their VAT payments. Those VAT payments can be paid over the next 11 months rather than as a one-off. It's an opt-in exercise, so there is a positive action to take, but there's no standard of evidence or proof that you can't pay immediately required. It is purely a, do you want to pay what you deferred last year or don't you? One interesting snippet around that is 30 billion of VAT is being deferred, but the revenue or Treasury expecting to recoup about 27.5 billion of that. So there is already an expectation built in that some of the businesses who deferred that VAT last year will never be in a position to repay that VAT.
Right. Okay. Moving on to the next one. There are also some targeted measures around VAT in the hospitality sector. Could you give us a summary of those?
Yeah, absolutely. So those businesses, we just talked about the deferral of VAT from last year. They can obviously take advantage of that. What we also have is an extension of the 5% VAT rate in the hospitality sector. That's essentially, a means of reducing cash outflows in that sector in terms of tax payments that are going to be made through the rest of this year, but also just helping them increase the margin in what they do. Back to this job retention piece. If they can keep more of the payments from their consumers, there is more money to protect the jobs that may be currently furloughed and bring people back to work more quickly. So that 5% VAT rate in the hospitality sector, that will be extended through to September. It then increases to an intermediate rate of 12% and then back to 20% from March next year. So a very targeted measure, but actually we saw last year the number of employees being supported by the job retention scheme fell dramatically during the summer when the hospitality sector opened up. We had close to 10 million being supported by that scheme in April, May. That fell to about 2.5 million during the summer, and has crept back up to 4.5 million. So you can see how that job retention scheme, the numbers are driven by the hospitality sector, and they really want to get that motoring as quickly as possible.
Good. And then onto the sin taxes. It's probably the thing that all of us look at in the budget and think, how much more am I going to spend on a pint? And let's be honest, with homeschooling, we probably all turn to that wee glass of wine at the end of a night just to ease the pain a little bit. But these remained untouched. So why do you think that was?
I think it is. I mean, there are a number of pieces to this, but getting consumer expenditure driving again, particularly in the hospitality sector, is crucial, as we just said, because of the disproportionate amount of employees who are supported by the job retention scheme. So again, it's a means to defer any additional cost into that sector. It could have gone a stage further by reducing some of those tariffs, but that's more difficult to do than actually maintaining a current balance. So again, it's part of the bigger picture, but obviously has its residual benefits if and when the time comes you enjoy going out for a meal or a pint or whatever it might be. There's some residual stuff around air passenger duty, etc., where actually some of these taxes have gone up, but there are some very niche things. I think at a general level, it's let everything sustain as far as possible and reduce the pain for some businesses along the way.
Brilliant. So fairly good news on VAT across the breadth of the budgets. Thank you, Seamus. We're going to move on now to customs. So I'm going to welcome Matt Clark in. So Matt, there weren't actually a lot of key changes to duty rates. Why do you think that was?
Echoing what Seamus has just said, to be honest, I think it's very much they want to help the economy come out of COVID basically and get back to normal and boost trading. So the customs duty rates are set by the UK external tariff, so the global tariff, and that was set and only came into effect on the 1st of January. So I wouldn't expect any customs duty rates to change for the foreseeable future. They'll let those bed in whilst people get used to those new rates, which are slightly different to the ones we used to under the EU tariff regime. And as Seamus has said, the other part is the excise duties. They've all remained the same. Again, I think it wouldn't have been good for the economy at the moment if they brought in an additional hike to those. I wouldn't expect an increase until later in the year, potentially the year thereafter. There was quite a large consultation paper on alcohol that came out from the government last year, and they're looking and reviewing all the answers to that at the moment. So I think we can expect some new excise policies around the alcohol industry, and perhaps a change in the rates to come out either later in the year or early next year instead. But I think it's just encourage trade at the moment, keep everything moving, and don't increase prices for any industry within the UK.
Okay, and then I know we spoke about this when we were prepping this, about the Free Ports Initiative, which was referenced quite a lot. I believe it's something we did have in the past, but can you provide a quick view on that and how it could help trade development in the UK?
We did use that. You're absolutely right. We did used to have free ports back in the 80s, if people remembered them then. It is something that the EU themselves have kind of tried to move away from. What a free port gives you is an ability to bring goods or raw materials into it, similar to a customs warehouse, but rather than it being a physical building, it's an area of land. Normally, they're close to the biggest coastal ports or airports. So the ones that have been announced, I think, are Felixstowe, Liverpool, Hull, Southampton, London Gateway, Plymouth Teesside, and East Midlands Airport. So they're the ones that they've brought in, and it gives you the ability not to pay customs duty on those goods that you bring in either to store or process if they then move out again. So it does give you a definitive customs duty benefit. But I think one of the other things that was quite interesting was that there was other taxes that they said could certainly benefit from within free zones. So as an incentive for companies to set up there, so stamp duty, rebates on construction and machinery investment, 5 years zero business rates, and lower tariffs from a customs perspective. So there's lots of different incentives to regenerate those areas, and a lot of them are kind of not being used to their full potential at the moment. There's an awful lot of land there where people could build warehouses and manufacturing sites to benefit from the free zone status. So I think it's a good thing. I think it'll start to take time to see the benefits of that, Michael, because you've obviously got to set up the zone first, get the infrastructure there, then invite the people to come in and invest and create their new operations there before you start to see benefits. But I think it's something quite exciting for the future that will also help eliminate some of those teething problems that we're seeing for trade between the UK and the EU.
Thank you. It's really useful to hear that, because I think a lot of people would have heard that phrase, and for you to just clearly define what that means, I think that's helpful to a lot of businesses. Stimulating trade as we hopefully come out, and I really do mean hopefully come out of lockdown, it featured a lot. So how is UK trade right now, and what's in store for the remainder of the year now we're post-Brexit?
Well, I think certainly from our perspective, and we not only just have clients that we provide consultancy advice to, but we also do brokerage now for importers and exporters. And what we've certainly seen in the first quarter is not the volumes that we anticipated. And I think the reason for that, Michael, is an awful lot of businesses either built up a significant amount of buffer stock within the last quarter of last year. So they brought in enough goods to see them through the first couple of months of the new year and not need to import or export as much. So it's only really industries where you need a constant stream of goods, for example, food. So you still obviously see the food moving in both directions across the channel. But other industries, they haven't done as much. COVID has obviously impacted all industry within the UK, so there's not been as much manufacturing happening. Certain businesses are shut and can't reopen until we come out of lockdown. So I think as we go through April and the country slowly starts to ease itself and come out of lockdown, the demand for certain goods and shops moves up, manufacturing really starts in earnest again. You start to see trade increase. So I think it's been a little bit quieter probably than was expected, but I think it will ramp up over the year.
Good, and that's really positive to hear. So I'm going to come finally to Nick Forrest. And Nick, I hope you've been dusting off your crystal ball and you're going to tell us how good the future is going to be. So starting off with an obvious one, what is your expectation for the shape of the economic recovery?
Thanks, Mike, and good to be with you this morning. We provide a regular monthly update on the economy, so I'll draw upon that in answering that question. But do also look at our website where you can sign up for that monthly update. Before I look at the outlook, firstly, uncertainty, I thought I'd touch on that because I think what's different now compared to what we had when I think we last did one of these events in November is a real change in the level of uncertainty. I think back then I said, what happens if we get a vaccine, Joe Biden administration, and a trade agreement? And we've kind of got all three of those. So I think the degree of uncertainty has dropped substantially in the last few months. There's a real clear path now to recovery, which I think is really helpful for businesses in terms of medium-term planning rather than just the kind of crisis planning that they have been doing. In terms of the shape of the recovery, I'm going to give you another letter. I know every economist with every presentation brings out another letter of the alphabet. So this time I'm going to go with the S, a bit of a kind of sideways S. What I mean by that is slow, quick, slow. So I think this quarter has been slow and worse than the last quarter. And the plan for phased opening up of the economy is gradual. So I think it is a sort of slow unlocking of the economy. Then I think it will speed up, particularly post April 12th. I think we get the reopening of non-essential retail. You may have heard about this 125 billion of forced savings in those people who have been in work and been able to save. It's probably now about 150 billion now. That was a year-end figure. Now, not all of that money will come straight into the economy. Surveys have suggested maybe only about 10%, but there will be that extra boost of that income coming into the economy. So that's the quick reopening boost. But we do worry a bit about kind of that slowing down and some of the longer term lingering COVID effects, higher unemployment, which takes a while to come down, some structural readjustment that will take time, whether that's city centres or whether it's kind of the transport industry. That's not quick. So we think that will then slow down the end of the recovery. So that's the kind of the shape we're expecting. In terms of forecast for 2021, we had two scenarios, a rapid and a slow recovery, showing 4.6 and 3.4% recovery. Now the OBR came in right in the middle of that at 4% for this year. Now those numbers may sound really quite low, and that's probably because Q1 this year has been compared to a good Q1 last year. So actually it'll feel like a quicker recovery than that. It's just the numbers are low. But we are currently, or in December, we were about 6.3% below our peak. That should mean we'll get along the way back this year. I think the Bank of England think we'll get back to our peak in Q1 2022. The OBR's Q2 2022. We were more the back end of 2022. But I think the budget's helped actually. I think the budget with the boost to business investment, the OBR I think about a 10% boost through those capital allowances, that super allowance. So I think that will kind of bring forward the point in which we get back to where we are, probably by about 6 months or so. So I think a positive budget. There was quite a big continuation of the protection schemes, but also incentives to get business investment going. We always thought there'd be a good consumer recovery in the summer, but now hopefully there's more for a business investment recovery at the same time. So 4% for the UK, that probably will be lower than the rest of the world, more like 5.5. So I think Brexit will drag the UK behind, but yeah, we do have a recovery in store.
Good, thanks, Nick. And I always feel happy after hearing from you, Nick. No matter what's going on, it always feels more positive. And it's also stretching my alphabet even more because I think I've had from you the V, the W, the kinked V, the sideward S now. So we've only got a few letters left. But let's move on. And this is definitely a chat that I hear from lots of the parents when we end up meeting at a playground, which is all there's been to do in lockdown, if we're completely honest. Are you worried about the amount of debt the government has now borrowed, and how are we ever going to pay it back?
Thanks. So I'm not particularly worried because I think borrowing was the right thing to do, and the markets understand not borrowing this money would have led to a far worse economic outcome. So, but it is a huge amount of money. £344 billion announced on COVID support. But I think two reasons why I'm not worried. Firstly, once we get through the COVID period, I think it will come down very quickly. So a lot of these schemes will come to an end. The Chancellor has been very keen to make sure he's extended them to the point where they're no longer needed, but they will come to an end. And the Office of Budget Responsibility thinks the deficit will come back down to 17 billion, 0.7% of GDP by 24-25. So the deficit will naturally come down. So it's more just a debt problem rather than a deficit problem. In terms of the debt, actually, the important thing I think of is the cost of servicing that debt, because interest rates are a lot lower. So the cost this year of servicing that debt is only 2.4% of government revenues. It was 3.5% last year. So the cost of servicing it really is not as bad or as high as it was in relative terms. So we are exposed to higher interest rates and inflation, which we might come on to. But actually right now, I think there's a plan for the deficit and the debt is affordable. So I'm not overly worried about it.
That's good to know. And yeah, you rightly said we are going to move on to inflation. Actually, we had a question from Graham. So this kind of dovetails with what you were going to say about Nick. So I'll go with Graham's question, if that's all right. So his question is, what's the expectation on how inflation will be affected by government spend plans and increase in corporation tax? And I know for you it was, is there a risk of excessive inflation?
Yeah, thanks for both those questions. You do hear about this concern, particularly in the last few weeks, about kind of excessive or inflation really increasing a lot. I think it's worthwhile remembering that this crisis has not been an inflation crisis. It's been a crisis around economic activity driven by the necessary response to the pandemic. So if there is a risk to inflation, I think it's pretty remote, actually. I think so the OBR thinks that inflation will just gradually rise up to 2%. So does the Bank of England, because it's consistent with our view. And I think the government support has really been about sort of maintaining activity rather than kind of overly stimulating activity. So I don't think a lot of the government support, like furlough schemes, is particularly inflationary. I think there are a few things to come through to worry about. So the energy price drop in April last year, that will sort of drop out of the annual figures, and energy costs I think will rise. But the economy is far less sensitive to the oil price and energy cost than it used to be. There may be certain supply constraints in parts of the economy through either trade-related blockages or readjustments to the structural changes necessary. So there may be some of those inflationary pressures there. There will be this bounce back I talked about, but I don't think that'll be particularly long, and it'll be a sort of one-off. Again, less concerned about that. Some of the deflationary pressures from the last decade, low-cost goods from China, they may not be as strong as they have been in the past. So there are definitely inflationary pressures out there. But with unemployment, I don't see wage pressures really increasing, particularly, and that will provide an extra sort of buffer to inflation. And if there is an increase in inflation, I think it will be relatively temporary. The bank will look through it, so they won't adjust interest rates that quickly. And if they really need to, whether it's fiscal, which of course we do need more tax revenues, or monetary tools like interest rates, they're strong and they will be able to sort of bring down inflation if required. So I'm not overly concerned about the inflation risk outlook.
Okay, moving on to super deduction. So we've had a couple of questions about this as well, which I think Sam's been answering, which is great. But will the 130% super deduction investment tax incentive be effective?
So I think there's a well-considered policy. As I said, it's going to target investment, which is always weak at this time of the economic cycle. It'll also be helpful targeting more traditional businesses rather than kind of digital businesses. It'll probably have a better, more representative or impact in the north. So it's kind of consistent with the levelling up agenda. It's a generous 2-year window, so it's a good time to it. So I think it's economically, I think, a well-targeted tax measure. And I think the OBR's looked at international comparisons of this and think that we will increase investment, whether that's firms bringing forward their purchases. A lot of firms may do this investment anyway, but those that maybe then might have extra investments or expenditure for other purposes. So I think it will give an economic boost. 10% of business investment is a significant boost to the economy at a time when it's needed. Okay,
and then finally, before we go to the Q&A from the audience, what other policies do you expect from government to support recovery and its wider agenda?
So the budget was full of continued COVID support, which is I think absolutely necessary and correct. It was pretty light on green and environmental aspects. Now maybe we'll hear a lot more this year with COP26 coming around the corner. And there were some policy announcements, the UK Infrastructure Bank, for example. I think there's a lot more that can be done on the green recovery, particularly in relation to the home domestic heating, whether it's electric cars and the infrastructure for that, or heat pumps. There's a whole range of I think policies in the green and environmental area that could be turned up. I think on levelling up, I think we'll see more of that to come. There's the 4.8 billion levelling up fund, which looks promising. I think what I liked about that was it was moving the levelling up to more of a locally sourced agenda. So communities having more control on how they want to develop their communities. We've done some research on this recently and found that actually people want local jobs, local housing, and local high streets more than they want, gleaming infrastructure projects. I think this fund seems to be taking levelling up into that direction.
Okay, thank you very much, Nick, and to all the speakers. So we'll move to questions now from the audience. I know there's been some answers, but I may still go through some of these anyway. So one that was actually close to my heart, because we're actually rolling out an ERP implementation for a large company in Hertfordshire, from Andy Dartnell, who's asked, would capital investment on a new ERP system be eligible for the super deduction? Sam, should I come to you for that?
Yeah, absolutely. So obviously, it's subject to the usual caveats that any tax question is always going to depend on the facts. I mean, as we understand it at the moment, the answer is sort of broadly yes. So, the general principles and the general shape of the capital allowances regime at the moment, software expenditure is treated as plant and machinery for capital allowances purposes. And the way the super deduction has been drafted, if you've got qualifying plant and machinery spend on new assets, then that should fall within. And so I'm not aware at the moment of any specific exclusion from the super deduction rules that would take that out. And so I think you're probably looking at your normal tests, I suppose, as to whether it's capital allowance qualifying. So yeah, it's a as always, it depends. But in principle, I think it should, yes.
Thank you, Sam. I think there's a lot of people obviously doing ERP upgrades and looking at it right now. I'm going to come to you next, Seamus. So we've had a question from Graham. What level of scrutiny do you expect around the deferment of VAT?
So the deferral is an opt-in exercise, but I think, as I mentioned, there's no standard of proof to demonstrate that you can't pay that VAT bill right now. It is an open offer from HMRC. So if the business has deferred VAT from last year, it can either choose to pay that this month or choose to go into this deferral system. So, there will be a point in time where, every business is subject to VAT audits, and the underlying amounts of VAT that made up that deferral can be subject to scrutiny at a future point in time. But I don't think there's any specific targeting against or planned targeting of the deferral mechanism as opposed to the general VAT audit regime that happens in the UK.
Thanks, Seamus. I think I might be coming back to you here, Sam. I've had a question from Jin. Is there any tax incentive for carbon zero investment?
So the short answer is no. There's nothing specific in the budget announcement on carbon zero investment. So we did see the government sort of reaffirm their commitment to net zero through the Green Investment Bank. So we've got, and there is funding available to support it, but in terms of specific tax breaks, no. So we've got the Net Zero Innovation Fund, but we don't have specific tax breaks over and above what already exists for energy efficient investments. Now, whether that's something that we see further movement on over the next year is harder to say. I'm inclined to think that we should continue to expect more developments in that area, because I think that we're seeing more and more traction around carbon zero investment, and I think that we might well see stuff announced over the course of the next year. But for now, no, there was nothing in the budget.
Okay. Nick, I think I might come to you for this quite broad one from Francois. So are the £4 billion public spending cuts real or purely mechanical as claimed by the Treasury? And if the latter, what mechanical means?
Oh, I wonder if the £4 billion spending cuts. I wonder which ones those relate to.
Francois, if you're around and you'd like to comment back to your question to put some more detail on it, then we can come back to that one again.
Yeah.
I know that we've got one here as well, so I'll come back to you on that one, Nick, whilst waiting for Francois to reply. We've got an anonymous one here. What's the speaker view on the scrutiny of bounce back loan, payroll records, and is there any update on IR35? Just a few questions in there. Who'd like to take that one?
I'll start more generally, and then I think perhaps Sam, you pick up the IR35 piece. You heard earlier that there is a specific, I use the term loosely, task force focused on the scrutiny of the job recovery support scheme. So an additional just over 1,000 people focused on that. And we do expect, I mentioned that there is a standard review and audit regime for all taxes across the UK, and you can expect as part of that, detailed review of any claims that have been made. There is an understanding within the Treasury that fraudulent claims have been made. It's difficult to understand the extent of that, but we've seen some press headlines around some action being taken. So there's some specific targeting in some areas to the job recovery scheme. There will be a general, as part of the ongoing audit process, a review of these types of claims or deferrals or whatever it may be built into that standard audit process as well. So there's a bit of a two-pronged approach going on.
Okay. I'm going to come back to you, Nick, with another question. I think this will be you. So due to COVID, Brexit, what will be the impact on housing and currency? Getting your crystal ball out again, I guess.
Housing and currency. So yeah, two quite different things there. So housing. So we've all been quite surprised by how strong the housing market was last year. 7% growth in the residential side, and still growing in January. So the housing market has been pretty resilient, and I think we'll carry on through this year. I think that level of growth won't continue, but I think we have avoided a major drop in the housing market through this crisis. So that's housing. On currency, I think we're interestingly in the world where the US dollar has been particularly weak. That's kind of a defining feature of global currencies. I think that's been a consequence of Biden's fiscal 1.9 trillion package, and also the Fed having a very open view to monetary policy and looking through inflation, if that were to arise, and looking at an averaging approach. So I think that weak dollar has supported the global economy. It's supported things like emerging markets and trade. So I think that's probably the defining currency in the world at the moment.
Okay, Sam, we're going to come back to you for one here from Joe. Are there any benefits to carrying back a tax loss at 19% versus carrying one forward at 23%, aside from cash flow?
So, I mean, yeah, so obviously you're right that the main benefit is just the cash flow advantage. I suppose the other circumstances where it might be useful are just where you've got questions over your ability to use the loss going forward. So whether that's because there's uncertainty as to sufficiency of profits at the one end of the extreme, or at the other extreme, whether your carried forward losses will be capped out so that you're only able to take 50%, you're only able to offset 50% of your profits. So I think, generally speaking, unless you're one of the two extremes, no, it's going to be sort of cash flow advantageous to take it back, but overall tax advantage to carry it forward.
Thank you. And there's a question here from Rob Welsh. So do you think there will still be a retention bonus at the end of the furlough scheme? Because I know from our business, we've been quite hot on this and it's quite a hot topic. So who would like to take that one?
Happy to jump in, although I'm not sure that I can. I'm happy to speculate, but I'm not sure I can add a huge amount of insight on this one. I think for what it's worth, my view is probably yes, but I think it's going to depend very much on how the statistics shape up over the next 6 months, really. I think at the end of the day, these decisions are going to be based on how we're seeing the jobs market recover, and what we're seeing in terms of and admittedly it's a slow fading in, but as employers start to pick up 10-20% of costs, are we going to see that having an impact on retention? So I think I don't know, I'm going to hedge my bets and say wait and see, but probably more likely than not.
I'm very brave there, Sam. Thank you for doing that. I have got another question for you that's definitely in your area of expertise, though. So someone had already asked this and you've answered them, but Paul's now asked the same question. Can partnerships avail of the CT super deduction if they lease assets? Yes,
I mean, broadly the answer is going to be yes, but as ever, it's yes with a but. I mean, so in terms of the super deduction, our starting point is the normal plant and machinery capital allowances regime. Essentially, this just sits on top. So we've got a few specific exceptions, which are principally around leasing businesses. So it's actually at the other end, actually. So if you've got, if your business leases assets to others, so if you're a commercial landlord, for example, then you're going to be restricted here where otherwise you wouldn't be. But if you're on the other end of that relationship, then you're just subject to broadly the normal rules. So what that means is, obviously there's a fair amount of existing complexity around capital allowances and leased assets, and where you fall in the sort of finance operating lease distinction, whether you've got long funding leases, and so who's eligible to claim the allowances. But subject to those existing rules, if you're leasing an asset that qualifies as new plant and machinery, you're potentially in. Obviously, the interaction that we need to be careful with, I suppose, is the rules around second-hand assets and understanding the specifics of the transaction. So it's a qualified yes. It will very much depend on the facts, but it's certainly not ruled out explicitly.
Thank you, Sam. I think we are out of time for any more questions. And Matt, I'm so sorry we didn't come to you with any. I don't know if people have got an element of Brexhaustion still and just had enough of talking about customs, but maybe you just dodged some bullets as well. I don't know. But thank you very much to the speakers. Absolutely fantastic information there. Thank you very much. And thank you to everyone attending. As a follow-up to this, we will send this recording out. We'll also send the details of the 4 speakers that you've heard from today, in case there is anything that they can assist you with your business. And obviously our details will be there too, because we would love to assist your business bounce back from what has been one of the most challenging periods that any of us have ever worked through and probably will ever work through. But thank you all very much for attending, and I wish you all the best for this year. Thank you very much, everyone.